What's going on, guys? It's Josh again, and today I'm going to talk about this number one question I get. The stock went up, but my option didn't go up in value. What happened? I woke up, the stock was up, but now it's worthless. This happens a lot if you don't know what you're doing and you don't understand the dynamics of a contract. So I'm going to talk about it. I'm going to show an example as well as even talk about how the stock could stay the same price, but you could still lose money. And I'll show you with the contract that I'm holding. I'm up like 500% on it. But now, as always, before I get into it, drop a like on the video, man. Y'all in that thumbs up gang. Like I said, I don't know how I feel about that term yet, but you know what the thumbs up mean if you with Josh answers. Drop a thumbs up on the video. Subscribe to the channel if you're new. Even if you're not new, make sure you turn on your post notifications so you don't miss any of these videos. I'm gonna just start deleting them if you guys don't see them. No, but anyways, let's get to it. This question, why does this happen? The answer is volatility, implied volatility, and time decay. And this is why I tell you guys, do not focus on simply the price of the contract. You have to understand what you're actually buying and what that contract represents. So look here, Tesla today, Tesla actually, from yesterday, closed here, went down, shot up a little bit in the morning, but stayed the same. But again, at the highs of yesterday. But this contract, this is the 360 I own. I bought it before earnings, and you guys can see here, I bought around $1, shot up to 600-700 yesterday, came down, closed around like $5, I think, hit $700 today, which was awesome. But I didn't sell out of it just yet. I was actually busy. I wasn't even looking at the market. But the contract, the stock is up, but the contract lost value. This doesn't really make any sense. You would think that it would go with the price of the stock, and no, because time decay. This thing is going to expire next week. And so now coming into this week, if the stock doesn't move up with how people were willing to pay $5-7, because as long as Tesla kept going this trend at this pace, they said, yeah, I'll pay $7 for it, $5, because I think it'll go hit that target and more. They want to buy that uncertainty. But the fact is, if it stays the same price for a long time, it's going to get killed by the theta or time decay and lose value, because now the longer it stays the same, the less likely it is to go up higher and higher. So people are going to pay less to have the right to the stock at 360. So now that's the quick explanation for that. And what I'm saying is, this is why I've warned it. If you guys were on the live stream, at certain times, even on the weeklies, at certain times through the day, even same thing applies to monthlies and longer terms. What happens is you guys got to be careful of what's happening to the velocity of the stock. Again, if a stock picks up fast and quick, that premium is going to go up. But if anytime it starts to lose that momentum, even if it holds the price, if the momentum doesn't hold the continuing upward fashion based on Black-Scholes, it is going to decrease the value of that contract. The premium is going to go out. So now the next question that I always get is like, I bought it on earnings, the stock went up 10%, but I woke up and I was down. You could look at it by seeing this contract here, the 352. If we take a look at it, this is a great example, because again, the stock was at an option was at 180, hit a low of 50 cents, shoots up to $3.98, but now it's at 5 cents. Why? Because this has to do with time decay and the price of the stock. And then again, it's about to expire today. So you have this, what I mean by understanding the value of the contract. And what I'm asking you guys is, would you pay somebody $5, $10 to buy Tesla at $3-4 more than when it's trading, when the market closes in 30 minutes? You have it till the end of the day. Why would you pay someone extra to pay them extra for the stock? It doesn't. Why would you pay someone any amount of money to buy the stock higher than what it's trading at? Man, you guys see that print? 3 cents in the 19? That's crazy. It just doesn't make sense. You wouldn't do that, and nobody else in the open market would do that. In the confines of self-interest, that doesn't make sense why anybody would make that transaction. So that's why it's low, and that's why, weeklies, as it comes closer to the date, it becomes less about what even if it has $100 of value hour before, you have to ask yourself, would somebody pay me how much? And if you want to determine the price, you have to ask yourself, how much would you pay someone to get the right to buy the stock at a higher price? And depending on how much further out, again, that's why anything above 352 doesn't really have a bid, because why would you pay someone $10 more than what it's trading at to not, to buy the stock $10 higher? It just doesn't make sense. Even then here, this one's like right at the money, but again, it's cheap because some people are saying, well, there's only 30 minutes left in market. I'll pay you 20 bucks to buy it 50 cents higher because it has to get to that 50 cents higher and then pass that price you paid for the option to 20 cents. So it just, the likelihood of that becomes less and less. So if you're ever buying an option, if you're buying it for earnings or even in general, you buy it on a weekly, you have to really make sure you come closer to the target. Now with weeklies, if you have the full week left and the stock has an upward momentum, you're going to get time premium, but that's why you have to really sell it. I was on stream, I sold some of my weeklies. Let me even show, here are the Facebooks I sold. I played it. I got a 177.50 for the week. And again, it's these contracts, but I sold these contracts. You know, they hit $1.20 yesterday. It's great. I sold them at 40 cents yesterday, or 40 cents, I believe, around here, 45, 42 cents. And yeah, I could have made double that, triple that, but that's because, you know, you really would have only had the morning. And again, I'm not trying to gamble like that. I'm going to just take my free money. And even though Facebook right now is at 177.50, you know, it's 3 cents above there. The contract's only worth 14 cents because it's right at the money. And then again, if this falls out right now, if you don't sell out in the right time, that contract is going to drop in value and pretty much close at zero. So it all depends. And even though the stock is higher today than where I sold it, even though it's in the money now, I sold it out of the money by like $2 or $3. I got 4 times the amount of this because, well, they're 3 times, simply because there was the momentum and I still had that little bit of time. But now once the time decays, it's like a shift, or a what's it called? A weight, where, okay, there's upward momentum, stocks going up, it's not in the money, there's going to be more value placed on time. But as every day goes by, as the stock doesn't keep moving in less time, you start to tip the balance, and then that's how you really lose your money. And that's how a lot of people get burned on options. And even then, you see why I sold this, because I'm not trying to play this game. You know, could I have held and the stock, you know, did what it did this morning and went up? I would have had one time period, you know, I would have had 10 minutes to sell out at 1,000% gain, and then right back to 69 cents. Came back up, you know, you actually had some decent moment, but eventually you'll notice as time periods hit, come around 11, really by the hour, you'll notice every hour it will take a fucking dive. So that's what you guys got to be careful of, and that should explain it. I'm trying to make this video quick, so hopefully you guys enjoy it. Hopefully this makes sense, and drop me some questions below. Love you all.